Hello, everybody. This is Sunko, the Korean bro. Today is 2023, June 14. Let's look at today's market, okay? Today we have a bullish trend again. Happy day. And let's see, okay? Mm-hmm. First, will the Fed pause rate hikes on Wednesday? Two e-commerce stock that could help set you up for life. One question investors should ask themselves before buying medical property stock. Canopy growth stock suffers another blow. Hmm. One stock split. Uh, okay, let's see. First, two e-commerce stocks that could help you set up for life. Coupang is a tremendous opportunity to capture more share of $550 billion retail market. Haha. Hmm. The stock is up 11% year up to date. Coupon. Okay. They could be on the verge of a sharp recovery after last year's haircut. Coupang posted 20% or better currency neutral revenue growth over the last 2 quarters. The company's Rocket delivery service, which offers next day or same day delivery on a wide section of products, is a huge success. Like Amazon, Coupang's fast delivery speeds and are proving to be a key advantage in helping it conquer an enormous opportunity in South Korea. Coupang still only controls a single-digit share of the Korean retail market, a market expected to reach $550 billion in the next few years. It's hard to overemphasize how staggering the opportunity is before us and how early we're on this journey, CEO Bom Kim said during the first quarter earnings call. Hmm. Let's look at the price of Coupang, okay? Hmm. 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 Okay. Hmm. Its revenue keeps increasing. Mm, okay. Hmm. What about Shopify's checkout system is everywhere online. Businesses of all sizes rely on subscription-based platform to set up and manage their online storefronts, as well as some brick and mortar parts of their business. Shopify makes it easy for any merchant to start selling online, and it's been an incredible growth story in recent years. But the sell-off in the stock last year is giving investors a great opportunity to score the stock at a discount. Shopify regularly reported revenue growth over 40% through 2021. Its growth slowed to 16% year over year in the second quarter of 2022. The stock collapsed, but the business is bouncing back as e-commerce recovers. Greater penetration of Shopify's payment solutions, including Shop Pay, helped push revenue up 25% year over year in the first quarter. The company is also seeing more customers convert from free trials to paid subscription plans, which is boosting top line growth. Shopify also started to focus on balancing top and bottom line growth. The company is exiting its logistics business, which will free up more capital to invest in merchant solutions and improve profitability. Shopify reported positive free cash flow of $86 million in the quarter, or 6% of revenue management now expect free cash flow to be positive for the rest of the year. Growing revenue and free cash flow are a catalyst to move the stock higher over the next few years. The stock already rebounded 87% year to date, but it's not too late to buy shares. Only 15% of Shopify's gross merchandise volume is from international markets. The company has a big opportunity to further help merchants expand globally with its Markets Pro service, which is gaining traction in the marketplace. Only 15% of Shopify's gross merchandise volume is from international markets, which is really small. Oh, okay, Shopify. SoFi. SoFi expanded into a full suite of digital financial services, and customers continue to sign up at a high rate. The company will post losses, but they've been improving over a sustained period. The stock is trading at a reasonable valuation. Let's look at SoFi. Okay. The fintech company reported high growth rates and it's cutting losses to improve its bottom line. Has followed a classic growth stock path since its initial public offering in June 2021 that includes soaring growth rates on top line revenue and customer acquisition, as well as bottom line losses related to its growth efforts. This kind of stock gets plenty of investor attention when there is a strong bull market underway, but it tends to get shone in a volatile economic climate where investors become more wary and focus instead on safer stocks. This pattern was evident as SoFi stock took a big hit in 2022, but with market sentiment improving in 2023, investors took some tentative steps back to showing an interest again in growth stocks. Many growth stocks were fairly sold off last year because their growth rates didn't justify their highly evaluated valuations, SoFi included. But investors are learning this year that SoFi's valuation was taken down a few too many notches and are reacting quickly to resolve that. As a result, SoFi stock is now up 104% so far in 2023. Can SoFi's business support this massive gain? It's its evaluation still misleading. Let's see where SoFi's business is going and where it could be a year from now to see if an answer reveals itself. Expanding social missions. SoFi began operation just over 10 years ago as a way to offer student loans and more competitive interest rates than was currently available. It's all digital, easy to use platform became popular quickly. The private company grew, and SoFi eventually went public through a special purpose acquisition company offering in 2021. As the company grew, expanded into a full financial services app with personal lending, investing, and even travel services. It's still focused on offering competitive rates and simplifying financial services. The business plan resonates with customers, and the customer count continues to climb. There were 443,000 add-ons in the first quarter for a total of nearly 5.7 million. Revenue growth is also robust. First quarter revenue increased 43% year over year to $472 million. Management is guiding for revenue to grow 32% to 35% year over year in the same second quarter. One significant headwind for SoFi right now is that the student loan payment moratorium, since this segment of its business has been its main revenue driver. Branching out into new products helps soften the heat and business is brisk in its other segments, but the pause in loan paybacks has hurt. Student loan originations were $525 million in the first quarter, or 50% lower than pre-pandemic numbers. But personal loan originations were $3 billion, a 20% increase over last year. Okay. Duolingo, Tesla, Duolingo. We got Duolingo here. Hmm. Wow, wow, wow. Duolingo. Hmm. Let's look at what this is. If Amazon is the hearty base in my recipe, Duolingo is the spice. And as is the case for most spices, you don't want to overdo it. So I'm allocating $7,500 or 15% of my hypothetical $50,000 portfolio to Duolingo shares. Duolingo operates a language learning app and website with over 20 million daily active users and almost 5 million subscribers. The company, which debuted via initial public offering in 2021, is laser focused on growth at this stage. That means its key metrics are user, subscriber, and revenue growth. And Duolingo is bringing home the bacon when it comes to those stats. Highlights from the company's latest quarter include 42% year-over-year growth of revenue, 62% increase in daily active users from a year ago, 63% increase in paid subscribers versus 2022. Like most early stage growth stock, Duolingo shares are volatile and they're not for every investor, but because of its solid growth and eye-catching app, Duolingo gets my nod for this hypothetical portfolio. Duolingo. Mhm. Microsoft, Apple, Tesla, Canoe. Intuitive Surgical. Intuitive Surgical. A couple of stocks that can be ideal for long-term investors to hold, not just for years but decades, are Intuitive Surgical and Google parent Alphabet. Intuitive Surgical still in the early ages of for its growth. Intuitive Surgical could be a huge healthcare company in the future. The company is known for its Da Vinci surgical systems, which use robotic assisted devices. They can make surgeries more precise and efficient. According to data from a Grandview Research, the industry for surgical robots was worth $4.4 billion in 2022, but by 2030, the number could rise to more than $18 billion as it expands at a compound annual rate of 18%. The pandemic has slowed down the business as shutdowns disrupted hospital operations, but Intuitive Surgical has still been able to maintain a growth rate of over 10% in the past 3 years. Okay, so enough with reading articles. I'm about to do some research on the ones that I invested. Hmm. First, what I'm going to do some research on is Chag. Okay, how artificial intelligence is used in education. Hmm. Yeah. Okay, tag is the one that I'm going to sell once it goes up to the level where I want to sell. Mm. Currently, it's minus, and like I'm expected to. Uh, well, we'll see. What about Weeks.com? Mm. The market poorly received checks quarter first earnings. ChatGPT has emerged as a potential problem. The stock is a big bargain today, but there are risks to be wary of. ChatGPT sent Czech stock off a cliff. Skill other segment, and the company says it saw strong growth in skills, offset primarily by the change in the acquired materials model, which is now a revenue share. Artificial intelligence is already changing the game for companies. Many are integrating AI language models into their existing businesses, while others expect AI to replace jobs that humans have historically performed. But AI can threaten companies too. Learning platform Chegg spooked investors when he acknowledged that the recent surge in students pursuing ChatGPT had begun hurting its business. Shares have shat nearly 40% in just days. Is Chad facing an existential threat, or is this a near-term scare and buying opportunity for a long-term investor? Here's what you need to know. How is ChatGPT affecting Chegg? Chegg is a digital learning platform for students. The company sells subscriptions to students, giving them access to learning tools, textbooks, ebooks, and more. Through Chegg skills, individuals can learn skills and create like IT, security, and software engineering. ChatGPT is an AI chatbot that can gather information on the web and respond to user queries in a conversational manner. It was launched in late 2022, but has become the internet's fast growing app in months. The question has become, do students need chat services if one can ask ChatGPT a question and get a complete answer? ChatGPT can even write essays in software code. The company recently reported first quarter earnings, posting a 7% year over year revenue decline. The company reported a 34% year over year decline in revenue in its skills and other segment, noting that the segment's performance was driven by strong growth in skills, offset primarily by the change in the acquired materials model, which is now a revenue share. Management noted on the earnings call that the student internet in ChatGPT surged in March, the last month in the quarter, which implies that ChatGPT impact was felt quickly. Hmm. The company's long-term outlook is a bit hazier than it was a couple of weeks ago. Still, investors should get some additional information over the next few quarters when you can start seeing trends in the business post ChatGPT. Investors should consider ChatGPT a legitimate threat to the business, but there could still be an investment opportunity. Analysts have slashed their expectations for Chag's earnings growth, but still expect double-digit profit growth over the long term. Meanwhile, the market has valued the stock to a price earnings a ratio of just 7.5, a likely bargain if Chag is on solid footing a year or two from now. Hype cools or Chag instills confidence in investors it can grow despite ChatGPT. Um, the stock's potential re-rating to its former valuation will create some great investment returns for anyone buying during the time of uncertainty. Check stock offers potential reward, but it's a roll of the dice on limited information. Whether that's an opportunity or a red flag depends on how investors see it. So, okay, ChatGPT has certainly mm, has become like a certainly like a threat uh, to business of Czech, but uh, integration of AI into their service mm, is a new potential. So of course, investors are worried about its potential, but we'll still have to see how they work on this. Uh, But what I know at this point is that I want to sell Chad if possible. If it goes up to some level where I want to sell, then I'm going to sell right away. Now we have Wix.com. Wix recent performance has been disappointing, but the company is betting on new products and AI to grow in the long run. Isn't that expensive today? Wix could be a long-term winner from here. The e-commerce industry is navigating a testing period, grappling with the impact of global economics reopening and the sluggish overall economy. Wix.com, an e-commerce solution provider, recently reported weak growth figures, echoing the overall weak industry performance. While investors pondering the potential for a rebound, it's now the right time to invest in Wix.com. Let's delve deeper into the company's current standing to uncover the potential opportunities amid these industry challenges. Wix growth fell to a multi-year low. Wix has been an outstanding growth stock. Since its IPO in 2013, revenue has skyrocketed from $81 million to $1.3 billion in 2021, boasting a remarkable 41% compound annual growth rate. But investors expecting a similar performance in 2022 were hugely disappointed. Revenue grew by 9% year over year, and bookings improved by a meager 4%. Like most e-commerce companies, Wix had a difficult time as it navigated a challenging macro environment. It didn't help that the company announced a plan to reduce its cost by $150 million, signaling that Wix hyper-growth days might be over. While growth investors were disappointed by Wix 2022 performance, some green shoots are emerging lately. In the first quarter of 2022, revenue grew by 10% and non-GAAP operating income reached a record. Driven by a 24% decline in operating expenses, the tech company also raised its full-year guidance for 2023 after its encouraging first quarter results. In other words, while Wix faces external headwinds, it tries its best to adapt to the challenges. So far, its results are encouraging. There are still reasons to be optimistic about the long term. While the bears have reason to suspect Wix best days are over, the bulls think the recent slowdown is likely only temporary. The Star Weeks has a track record of execution and innovation, evolving from a website builder to a complete solution provider that helps business succeed online and with which anyone can launch and scale an online business by leveraging tools like email marketing, e-commerce solutions, analytics, payments, and more. Hmm. So long as Wix can keep delighting users with better tools and solutions, it stands an excellent chance to attract new and retain existing users. To this end, its huge registered user base of 243 million, out of which only 6.1 million were premium users, presents an enormous opportunity for future growth. Besides, the recent advancements in artificial intelligence could open up even more opportunities for the company. Wix can improve its product offerings by leveraging AI to help customers succeed in the AI-driven world. For example, its AI-enabled website creation platform, Wix ADI, has been leveraging AI to help customers build websites since 2016. We can expect more AI-enabled products from Wix in the coming years, opening up new opportunities for the company to grow. And now AI tools can help you build websites. You can build websites for smaller business clients or create them for yourself to produce income from affiliated marketing, ads, or subscription sales. Website building tools like Wix.com can help anyone create a professional looking website through templates or Wix. Artificial design intelligence, you can quickly create websites for clients or build them to sell your products or promote affiliate marketing links. Let's look at Zuora. Many tech companies saw their valuation surge as investors turned to software-focused stocks amid the coronavirus pandemic, but gains for Zuora have been more muted. Software as service stocks were generally huge winners over last year as clients sought digital solutions to challenges created by the pandemic, but Zuora has traded roughly flat since the beginning of 2020. The company provides software platform for subscription billing and sales recognition that makes it easy for business to implement and scale recurring revenue streams. More businesses are shifting to subscription based models because this approach helps with customer retention and tends to be more profitable over the long term. Growth for the subscription economy has already reshaped consumer and enterprise markets. An increasing preference for recurring revenue streams should create long-term tailwinds for Zuora. On the other hand, the company has had a hard time bringing new customers on board its platform during the pandemic, and that meant its business and stock have underperformed other SaaS leaders. The company relies on large enterprises for the majority of its business, and large enterprises are often hesitant to adopt new business models and software platforms amid economic uncertainty. The good news is that the growth outlook appears to be improving, and Zuora trades at attractive levels for a SaaS company with big expansion potential. Zuora stock is still trades down more than 60% from the lifetime high of $37 per share it hit in summer 2018, but the company's growth outlook remains promising. Shares look appealing at current prices, and there is a good chance the stock will battle back and reach new heights. The company has a market capitalization of roughly $1.6 billion and traded approximately 4.7 times this year's expected sales. If you're looking for tech stocks that are primed for market beating performance, even with valuations in the sector under pressure, Zuora stands out as a top pick. Let's look at Zuora. Let's look at Block. Both of Block segments are posting incredible growth, and the business is on the verge of positive net income. Netflix's new ad-supported tier should only improve its financial situation, which is already strong. Through its Square 7 block offers merchants mission-critical services such as payroll, invoices, card acceptance, and working capital, tools that make running day-to-day operations easier. And through its popular Cash App service, Block lets customers seamlessly send money to friends, set up direct deposits, or buy stocks in Bitcoin. Both segments' gross profits rose by double-digit percentages year over year, which I view as extremely impressive growth given the uncertain macroeconomic environment. On the bottom line, Block's net loss of $17 million in the first quarter was much better than its $204 million lost in the years ago period. By cutting its sales, marketing, general, and administrative spending, the business is optimizing its cost, and consensus estimate actually call for a diluted earnings per share of $1.72 in 2023 and $2.40 in 2024. According to the company's most recent letter to shareholders, Square processed $46 billion in gross payment volume last quarter, and Cash App now has 53 million monthly active users. Despite what are obviously two sizable segments already, management believes that Block's prospects are incredibly strong. They view the total addressable gross profit opportunity for the overall business at $120 billion. To capture more gains, Block will stick to its proven playbook of launching new products and services and entering new markets. As of this writing, Block stock is down by about 77% from its peak price. A multitude of factors such as higher interest rates, lower economic growth, the bearish research reported have pressured shares, but I think the long-term outlook remains robust for this business. Its current price sales multiple of 2.1 offers an attractive entry point for investors. It's hard to find a more impressive vintage stock than Blocks right now. And last but not least, what I'm going to look at is DocuSign. DocuSign. So these past days, I haven't seen any articles about DocuSign. Hmm. Anyway, this is it for today, and I'm gonna see you tomorrow. Okay. Bye bye.